ndabona ataratangira.
So welcome for today's class. I hope we had a nice week. So as we join the class, kindly let's go to the chat, type your name, phone number, and you can even add email address so that we take attendance. As you join the class, type your name, phone number, name and phone number under the chat. Whenever you type it under the chat, it's saved so that when I'm recording, it is also saved in the recordings. That is why it's important to chat your name and phone number. You know, this time there is no physical signing. So that is the only evidence we are submitting that you attended classes.
We won't have a minute for finish.
So maybe let's just wait some 2-3 minutes, maybe until 1:05 so that we start. I'm just looking at the numbers, at least we be 20. So, but we are just starting. So maybe 3 minutes as we start. Justin, you are at University of Kigali.
ubu nagomba gukora icyumba cyawe wowe nkorera isuku gusa ntabwo nayibamo nuko nabona amafaranga yawe
So I think we can start so that those who come late, they know the cost of coming late. So I think we can start. Last time, maybe as we start, remember, if you are doing something else, you kindly mute. I don't want to mute people because when I mute, we lose that class touch, we lose that class environment. So what I'm really requesting that if you are doing something else, you are receiving a call, kindly remember to mute before you start attending to other things so that we don't interfere with the class. It's not easy for me to mute all because when I put everybody, I don't hear a voice. It's really difficult to teach. It's really difficult to talk for 2 hours without having some response. So I don't mute people because I want to get, if it's a calculation, I want you to be the ones to calculate for me. Again, I'm advising you, it's good to have some shorthand notes just to write somewhere so that you are active. You must have a calculator also so that when we are calculating, you are the ones who give me the figures. Remember, I have the option of calculating using the Excel formulas, but that will not help as much because in exams, you will not have Excel. So even though I have Excel formulas, I'll not be using them. I'd want us to be the ones to calculate so that we can know how to calculate and we practice in good time. Now, maybe some announcements which I'll also make at the end. Tomorrow will be the last class that I'm teaching standards. Please understand me. Tomorrow is the last class that I'm teaching standards. That means by tomorrow, there are many standards we would not have covered. And therefore, because I need to start those major topics as soon as possible. So, and therefore, I would request we have makeup classes every Wednesday at 6:30 to 8. Is it okay?
Yes, fine.
It's fine. Is it fine with the others?
Yes.
Every Wednesday, 6:30 to 8. Are we together?
PM or AM?
PM.
PM.
Yes. 6:30 because some people leave work and by the time they reach home, it's maybe 6:30. That's why I chose 6:30. So every week we'll be having a makeup class for
fine.
1.5 hours so that we cover the syllabus. And the makeup classes will be for the remaining standards. So all the remaining standards will be covering them under the makeup class. Now in the makeup class, so that you don't wonder, the class is very big. In the makeup class, I'll be combining Kigali and Msanze. Is that okay?
No worries.
So it will be the same link. So when 6:30 reaches, you just click that link, the same link that you have used for this. So I always don't change my link. I use the same so that we don't lose it. So, so where we have reached tomorrow, we will stop in the standards so that we start consolidation. Because I want us to do consolidation as soon as possible. I want us to do cash flows as soon as possible. And I want us to do group accounts as soon as possible so that we can remember them. You have at least 2 months to remember them before exams. So basically that was the announcement. Again, I'll remind you at the end of the class. But if I forget, you remind those who have joined late. So let's look at where we had stopped last time. Maybe let me take some 2 minutes so that we can move forward. So we were on property, plant, and equipment. We defined what property is. I'm not interested in that. Now, remember we said, what is carrying amount? Carrying amount is cost of the asset. So maybe let me add here because we are just moving fast. We said cost of the asset minus accumulated depreciation. You know how to calculate accumulated depreciation minus any impairment loss. Minus any impairment loss if it is there. That is carrying amount. So carrying amount of an asset minus accumulated depreciation, cost of an asset minus accumulated depreciation minus impairment loss. We looked at that. Cost of the asset, what is cost of the asset? We explained what cost is and we really took a lot of time. Depreciation, we don't have a problem. Residual value, once you have used the asset, the value of the asset that remains after you have exhausted its use, that is what is called residual value. I'm just skimming through this we covered last time. There is fair value. Now here again, we need to be attentive. What is fair value? The price at which you can sell an asset, less selling costs. the amount at which you can dispose your asset, you minus the selling cost. However, IAS 36 defines fair value as the price at which an asset can be exchanged for between two knowledgeable and willing parties in an arm's length transaction. If you don't remember that definition of fair value, just say the selling price of an asset or the disposal price of an asset, you less the selling costs. Disposal price less selling costs. Last time we also defined what is recoverable amount. I'm repeating this because it is going to affect our calculation in just a few minutes. That is why I'm repeating them. What is recoverable amount? Recoverable amount is the higher of, number one, fair value, what we have talked of, selling price of an asset less selling costs, or the price at which an asset can be exchanged for between two knowledgeable and willing parties in an arm's length transaction. So recoverable amount is the higher of fair value and value in use. You see, if you don't sell your asset, you can use it. Now, when you use your asset, it generates you some cash. The cash that this asset generates you over a number of years. Maybe the cash it generates in the next 1 year, in the next 2 years, in the next 3 years, etc. When you discount that cash, you must discount. Because if I'm to receive 1,000 in 1 year's time, that 1,000 is not the same as 1,000 today. So the 1,000 to be received in 1 year's time must be discounted so that we get its value today. So value in use is the discounted future values of cash inflows. Discounted future value, I can add it there. It's not there. I can add it there. It is discounted future values of cash inflows. So when you discount the cash inflows, that is what gives you value in use. Discounted future values of cash inflow. Now you compare, if I sold this asset, I will earn maybe 1 million. If I used it, if I sell it, I will earn 1 million immediately. That is fair value. If I don't sell it, I will be using the asset and it will be generating for me some cash flows. These cash flows, when I discount them, they are called value in use. So you compare the higher of the two. That is what gives you recoverable amount. What is the impairment loss? When we talk of impairment loss, this arises when the carrying amount of the asset is more than the recoverable amount. If the value of the asset is more than what you can get when you use it or when you sell it, in that case, we have impairment loss. So impairment loss arises when the carrying amount of the asset is more than its recoverable amount. And I remember last time I gave an example. If you have a vehicle, maybe you bought the vehicle at 10 million. As at now, maybe the accumulated depreciation is 4 million. It means the net book value of the asset, the net book value is 6 million. Now, if you were to dispose that vehicle today, the net book value is 6 million. Ideally, you should sell it at more than 6 million if you are to sell it. But if you sell it at a price less than 6 million, whenever you see me quiet, I'm just trying to mute so that we don't have noise in the background. I'm just trying to mute those who are giving us noise. So when you sell the asset and it gives you a value less than 6 million, it means there was a problem with your asset. Maybe the net book value was 6 million, but the vehicle was involved in an accident. So it reduced the value of the vehicle below the net book value. So if the net book value is 6 million and the vehicle was involved in an accident and you lost a further maybe 1 million as a result of that accident, so the 1 million extra loss is what we call impairment loss. How do you know there is impairment? If the carrying amount is more than what? If the carrying amount, let me put it here, it arises if the carrying amount is greater than recoverable amount. So when the carrying amount is greater than recoverable amount, in that case, it is impairment loss. Okay. Recognition. I'm really mindful of my time. I want to start calculation by 1:20. Today, I'm really trying to follow time strictly. Recognition of PPE. We said that when you want to recognize PPE, there are two conditions that must be met. Number one, it must be probable that future economic benefits will flow to the business entity. And number two, the cost of the PPE can be measured reliably. So number one, it is probable that future economic benefits will flow to the business entity. And number two, the cost can be measured reliably. Now, we said, Emmanuel, when you're taking your phone, switch off your video. So, Emmanuel, are we together? Okay, I'm monitoring what we are doing.
Yes, I'm together.
Okay, so when you pick your call, you switch off your video so that you don't interfere with the class because people are watching at the videos. So let's continue. Now, we are saying that in this case, when you want to recognize PPE, what is to recognize? In chapter 1, we had looked at recognition is taking the motor vehicle and including it in your balance sheet. That is to recognize the motor vehicle. Taking the furniture and putting it in the balance sheet. That is to recognize. Now, there are two ways to recognize PPE. There is what we call initial recognition. This is when you are recognizing the PPE for the first time. Maybe you have bought your motor vehicle and you want to now do what? You want to post your motor vehicle in your balance sheet for the first time. That is called initial recognition. Now, recognition in the second year, third year, fourth year, etc., we call it subsequent recognition. So recognition is two-way. The first year recognition is called initial recognition. And number two, the second year recognition is called subsequent recognition. Now, under initial recognition, PPE should be recognized at costs. That is the point here. We also looked at that. I'm still remaining with 1 minute. So under initial recognition, PPE should be recognized at what? Costs. Don't revalue the asset when you buy it. Just recognize at the price at which you bought it. Now, how do we calculate cost? We said cost is purchase price of an asset. You less any trade discounts and you add any taxes, what we always call non-refundable taxes. So the first item in the cost of an asset is the purchase price. If there are any taxes paid, you add the taxes to the purchase price and you less any trade discount. Only subtract trade discount. Any other discount, don't touch it. Don't touch on any other discount, e.g. maybe early settlement discounts, don't touch them. The second component of cost is what you incur to bring an asset to its present location and condition. Directly attributable costs of bringing an asset to its present location and condition. I also explained that through an example. And you remember the example I gave when you are transporting your car from Japan to here. The transportation cost is to bring an asset to its present location. The installation of speed governors, etc., to bring it to its present condition. I've given examples there. Number 3, dismantling, removing, and restoration costs. And number 4, borrowing costs. So that is what we covered last time. Now we said last time, I think this is where we stopped, but we covered an example. I remember that. Once you have calculated the cost of an asset, please let's get this right. Once you calculate the cost of an asset, any other costs you incur should be expensed. I'm repeating. After you have calculated the cost of the asset, purchase price, directly attributable, dismantling and restoration costs, and borrowing costs, once you have calculated the cost of an asset, that is, to calculate the cost is to know the amount you will take in the non-current assets. This amount to be taken to non-current asset, we talk of capitalization. Once initial cost of the asset has been capitalized, it has been taken to the balance sheet. Any cost you incur after that should be expensed, should be taken to the income statement. Unless if 4 of these conditions are met, again you capitalize. You add these again to the cost of the asset. I'm repeating. Once the cost of the asset has been calculated, in other words, has been capitalized and taken to the balance sheet, any cost you incur in the asset, maybe you've painted your house, etc., after 1 year, that should be what? Expensed. Unless it does what? It improves the condition of the asset beyond the previous performance. Now, IAS 16 is very clear on what is improvement. Number 1, modification of an item of PPE to extend its useful life. Now, when you modify your asset to improve, and there is evidence that the life of the asset has increased, in that case, the amount you spent to modify should be capitalized. Number 2, upgrading of machine parts to improve on quality. Number 3, if the quality of the product has increased, you should also capitalize. Number 3, adoption of a new production process leading to large reduction. If there is a new technology you have brought in and it leads to large reduction in operating costs, in that case, you should also capitalize. Number 4, if you extend your building, you do some extension, you should also capitalize. You should also capitalize if you extend your building, etc. Okay. I'm just trying to mute people who are not following instruction. Okay, so let's continue. So we looked at this example last week, the other week, we looked at that example. Now this example, calculate the amount at which the plant will be measured at recognition. So maybe let's go to that question. Let me open my Excel. We go to that question with the answers that we got last time. So this was the question. So maybe 2 minutes to look at the question. Smart Limited has recently purchased an item of plant from X Limited, the details of which are as follows. Basic list price is 240, trade discount is 12, ancillary cost, shipping, blah, 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 blah. Maintenance, we said, maintenance is not part of the cost. Maintenance is expensed. So this one is normally expensed. So maintenance is expensed because it is like repairs. So that is normally expense. So we continue. Smart paid for the plant within 4 weeks in order thereby obtaining an early settlement discount of 3%. This settlement discount is not capitalized. That is not capitalized, so don't include it. It's not capitalized. Next, SMART had incorrectly specified the power loading of the original electrical cable to be installed by the contractor, and the cost of correcting this error was 6,000. This was included in the above figure of 14. So in this electrical cable installation, costs of correction, those ones are expenses. This cost of 6,000 must be removed when calculating the cost because that is an expense. Number 3, the plant is expected to last for 10 years, and at the end of the period, there will be a compulsory 15,000 to dismantle the plant and 3,000 to restore the plant. These are dismantling and restoration costs. So calculate the cost. So we did the calculation there, it is still there. So the purchase price of the asset is 240 minus the discount of 30,000 to give you the purchase price as 2. Net purchase price is 210. Costs to bring an asset to its present location and condition. We have listed all those costs. Remember, 14,000 minus repairs of 6,000. Remember, we have not included maintenance costs. Dismantling and restoration costs is 15,000 and that. It gives you an answer. And borrowing cost was not there. So the cost of the plant is 263, 250. Now, I looked at past paper questions. I could not get a good question here. A good question is one that is very comprehensive. I'm not talking of questions in company accounts on IS 16. Questions inside company accounts in IS 16, we will be covering them as we cover company accounts. We'll be covering those questions, those past paper questions. So I'm not talking of that. I'm talking of a whole question of maybe 15 marks, of maybe 10 marks on IS 16 alone. I could not find it, so I was forced to use the ones in my notes. So let's read this example 2 quickly so that we move on. It is also in your notes. So let's quickly read through this and then we can attempt it. So take 30 seconds to read this question and then we do it. 30 seconds. The owner of Techno Spark, you are not settled. I'm just seeing a lot of light in your screen.
We have a problem of network.
Okay. So, okay. I've already talked to Valence and the AG, but they told me to formally write down that that travel allowance should be converted to bundles, but it's still a discussion. You know the mission allowance, if it can be converted to bundles, it can be good. Is it true? So read that question so that we do it. Read the question.
Which one?
Are you seeing the question I've shared in the screen? Can you see this question?
Yes, we see.
That one.
Yes.
It is also in your notes. It is also in your notes. Okay, let us now read it together. I start with the required. Calculate the cost of the building that will be included in the tangible non-current asset. So ABC Limited started construction on a building for its own use on 1st April 2007 and incurred the following costs. The purchase price of land was 250. Stamp duty was 5. Legal fees was that. Site preparation and clearance, materials, labor, architect's fees, general, overheads, etc. So next, the following information is also relevant. Material costs were greater than anticipated. So you can see material cost here was 100,000, but there is again another 1,000 there. So it is 100 million. So material costs were greater than anticipated. And on investigation, it was found that materials costing 10 million, remember this is 100 million because of these thousands there. On investigation, it was found out that materials costing 10 million had been spoiled and therefore wasted. And a further 15 million was incurred as a result of faulty design work. So you should remove these ones because these ones are repairs, maintenance, etc. So these ones should be expensed. So you remove these out of the 100,000. Let us continue. As a result of this problem, work on the building ceased for a fortnight during this period. So work stopped for 2 weeks. During the time that work has stopped, any cost you incurred during that time should be expensed. We saw this in IS 23. You remember IS 23, borrowing costs? Anytime that construction is suspended, you should not capitalize, you should expense. We saw that in another standard, which we have already covered. The building was completed on 1st July 2008 and occupied on that day. So calculate the cost. So in order to calculate the cost of the asset, the first item, number 1, is to get what? The purchase price. So purchase price of the land will be, look at what I'm doing, 250, 000 plus 5,000. That is tax. Are we together? Plus legal fees is also included. Legal fees is 10,000. Maybe to buy the land, the legal fees, you remember, when you buy land, you also pay legal fees. You pay the people who are the legal fees of that transaction. So what is the amount there? Remember, I know how to use formulas, but I want you to calculate. What is the amount there? You can unmute if you have the answer. What amount do we get there?
265.
Yeah.
265.
265. Thank you. 265. So that is purchase price we have already included. Number 2 is directly attributable costs of bringing an asset to its present location and condition. And here they are quite a number. So we will start from site preparation costs, etc. So we will start from site preparation. Site preparation. How much did we incur in site preparation? We incurred 18,000. You can see 18,000. Remember, I have the option of picking it from there, but I'm not doing that because I'm assuming you are writing. Next is material costs. Material cost, we were told something. What were we told in materials? We were told it is 100 million minus what was incurred here. Material costs were greater than anticipated. On investigation, it was found that materials costing 10 million had been spoiled. So you remove the one that was spoiled because that is an expense. That is not part of the cost. And then you remove and wasted, and a further 15 million was incurred as a result of faulty design. Faulty design is also expensed. So 15. So how much is that?
75.
Thank you. 75. 20,000. Okay, next, labor. There was also something on labor. I read something on labor. Labor cost is 150,000, but there is a time it was suspended. Do you remember suspension was there? As a result of the problem, work on the building ceased for a fortnight. During this period of October, it is estimated that approximately 9 million of the labor cost relate to that period. So the period, yes? The period that work stopped, we spent 9 million. So you remove that. You don't capitalize the time construction is suspended. So how much do we remain with? 141. Okay. Next, architect's fee. Architect's fee. Architect's fee.
20,000.
20,000. 20,000. Okay, let me put commas there. I know how to use the formulas. I'm not using them because I can just click up there. Okay, so architect's fee is that. General overheads, these are expenses. That you should not include. It is a what? An expense. Are we together? So this should be expensed. That should be expensed. So under materials, because you know what is to be expensed. So somebody to give me the total directly attributable costs. So the total is how much? $18 plus 75 plus 141 plus 20. How much do we get? So it will be 254,000. Next, we have number 3. Dismantling, removing, and restoration costs. Here we didn't have any. We didn't have any cost there. It is 0. So I've put it there 0. The reason why I'm putting it in another question, it will be there. This is just to help you in revision. Next is borrowing costs. The part to be what? Capitalized. The one to be capitalized. The borrowing cost to be capitalized. It was also not given. It is 0. So when you add everything, this is the total costs of assets to be taken to non-current assets in the statement of financial position. So this is the total cost of the assets to be taken to non-current asset in the statement of financial position. So what is the total? It is 265 plus 2 plus 0 plus 0. You get it? It is 519. Any question on how to calculate the cost of the asset?
We are noticing.
Are you now seeing? Are you seeing?
It is visible unless he has no network.
Okay. Now, the problem is, I don't know. Yeah, it is very visible. But whenever you have a problem, the person was asked, can you now see? You know, when you don't have network, you will also not hear my voice. Is it true? When network is not there, even the voice will not be there. So if you are hearing my voice, it means you have network. Maybe if you are hearing and it's breaking, you don't have network. Because from where I am, network is very good. Okay, so let's move on. That is cost of an asset. I will share with you again that Excel. Now, let us move on a step further. Can you see where I've gone back? So once you have calculated the cost, any cost you incur after should be expensed. Any cost you incur after should be expensed unless it does that. Please let us now move to this. This is very important. We said in initial recognition, PPE should be recognized at cost. However, in the second year, third year, etc., subsequent recognition is now the second year, third year, etc. Second year, third year, moving onwards. That is subsequent recognition. Second year, third year, moving onwards. Now, in subsequent recognition, there are two methods that the standard allows you. You can either use cost method or you can use revaluation method. So you can decide that I'll still continue showing my asset at cost. Another person can decide that they will be revaluing the asset every year. Whichever method you use is right. But in exams, follow the method you have been asked to use. In exams, follow the method you have been asked. If you have been asked to use cost model, follow cost model. If you have been asked to use revaluation method, follow revaluation method. Okay. Now, let us start with cost method. Cost method. So what are we told about the cost? You know how to calculate the cost of the asset. Now, the first point is when you decide to use cost method, it does not mean you will not revalue. You can decide to revalue, yet you still follow what? Costs. You can decide to revalue, yet you still follow cost method. So that is what I'm trying to say in this second point. The adoption of the cost model does not mean that the asset is not revalued. You can still revalue, but you show it as an additional information, as a note to the financial statements. Now, remember when calculating the cost and you want to take it to the balance sheet, we are now in the second year. You must calculate the depreciation of the first year and you subtract because we are in the second year. Now, which depreciation methods are you allowed to use? IAS 16 does not tell you which method to use. You can use any method you want to use to depreciate. However, it recommends these three methods. IAS 16 recommends that you can use straight line method, reducing balance, and sum of digits method. Is there a method you don't know here? Because here they assume you know financial accounting. Okay. Revaluation. When you decide to use the second method, I'm just rushing so that we go to calculation. When you decide to use revaluation method, there are rules of revaluation. Please master these rules of revaluation. The first rule of revaluation is when an asset is revalued from a certain class, from a certain group, all assets in that group must be revalued. When you revalue an asset from a certain class, all assets in that class must be revalued. What do you mean by that? We have different classes of assets. We can have PPE, we can have land, we can have furniture and fittings, etc. Maybe let's talk of furniture and fittings. Or let's talk of PPE. You have decided to revalue building A. If you decide to revalue building A, you must revalue all buildings you have. Don't revalue one building and leave out other buildings. That is what the first point tells you. When an asset is revalued from a certain class, then all assets in that class should be revalued. Number two, revaluation should be carried out consistently. You should be consistent in your revaluation. What do you mean by that? When you decide to revalue after every 2 years, ensure after every 2 years you revalue. Don't skip another 2 years. If you decide to revalue after every 1 year, ensure after every 1 year you revalue. If you decide to revalue after every 3 years, ensure after every 3 years you revalue. Don't forget to revalue. The third rule of revaluation is the revaluation surplus is calculated. In other words, when you find that your property value has increased, your property value has increased. The amount by which the value has increased, maybe previously the cost was 1 million, and now the new revalued amount is 1.2 million. There is an increment of 200,000. This increment of 200 should also be shown in your equity. And we call it revaluation reserve or surplus. So that is what we mean by point number 3. Revaluation surplus is included in equity, and is shown as part of shareholders' funds. That is, it's part of equity. And finally, if, for example, we revalued the property and we found that the value of the property increased, maybe by the time we were valuing, the books were showing the value of our property is 50 million. Now the value has increased to 60 million. The value has increased to 60 million. Therefore, revaluation surplus is 10 million. It's called revaluation surplus. It's 10 million. And the life of the asset that is remaining is maybe 10 years. 10 years is the lifespan of the asset remaining. So this revaluation surplus of 10 million is taken to the equity, and then you take 10 million, you divide by the number of years remaining. 10 million divide, I'll give you an example, don't worry. We'll solve an example. You take 10 million, divide by the number of years remaining. So that is 1 million per year. So every year, you depreciate the 10 million by 1 million. You reduce the value by 1 million every year. That is what we mean here. A transfer from revaluation surplus account to the retained earnings should be made in relation to excess what? Depreciation. The transfer is the 1 million that you are removing from revaluation reserve every year. Okay. Now, I've really talked a lot. Let me maybe derecognition, and then I stop talking. We go to an example. Derecognition. What is to derecognize? To derecognize is to remove an item from the balance sheet. To remove the PPE from the balance sheet. When do we remove? We remove an asset from the balance sheet if it is sold, when it is disposed. And number 2, there is no future economic benefits from the asset. The asset is no longer helping you. So if there are no any future economic benefits from the asset, you dispose the asset. You remove the asset. Now, please, questions on IS 16. Please write down this if you have a book. Summary of the standard. This summary is important so that when you are revising, you know. Summary of IAS 16. Please take note of this summary. Let me increase the size so that everyone can see. Summary of IAS 16. When you are revising any calculation question, number one, you should know how to calculate the cost. How to calculate what? Cost of PPE. You should know how to calculate cost of PPE. So you should know how to calculate cost of PPE. That is, what does it include? Purchase, we have said purchase price plus what? Taxes minus trade discount. I'm summarizing that so that we just look at an example and we go on. Number 2, attributable cost of bringing an asset to its present location and condition. Costs you incur to bring an asset to its present location and condition. That is A. B, that is what you should have. Number C, what have we said in number C? Number C, you should know dismantling, removing and what? And restoration. And number D, you should also include borrowing costs. Borrowing costs. So when you are calculating the cost of an asset, please remember that. Those are what you should remember when calculating the cost of an asset. When calculating the cost of the asset, that is what you should remember. Number 2, the other point you should remember in this topic is our number 2. Number 2 is conditions, circumstances when costs incurred after initial recognition are what? Capitalized. Circumstances when costs you incur after initial recognition are capitalized. A, modification to increase the lifespan. To increase what? Lifespan of the asset. Lifespan of the asset. B, I hope we are seeing. B, after modification, there are others that we had talked of. Modification, next, upgrading to improve quality. Upgrading to improve what? Quality. Upgrading to improve quality. C, we talked of adoption of a new process. Adoption of a new process. Adoption of a new process to reduce costs. To reduce costs. And D, we talked of extension to a building. Extension to a building. That is the second item you should know. So number 1, you should know that. Number 2, you should know the circumstances. Number 3, steps in accounting for accounting treatment. Number 3, the third item you should know, accounting treatment of PPE. Accounting treatment of PPE. Accounting treatment of PPE. So let me put it in the next page. Accounting treatment of PPE. So in accounting treatment of PPE, there are 4 steps. Step 1, please remember these steps. Calculate carrying amount. Calculate carrying amount. How do you calculate carrying amount? Carrying amount is equals to cost of the asset minus accumulated depreciation minus any impairment loss. That is step 1. You calculate the carrying amount. Step 2. Step 2, you calculate the recoverable amount. Calculate recoverable amount. Remember, recoverable amount is higher of, accounting treatment was number 3, sorry. Higher of what? Fair value. And fair value, higher of, let me bring it down. Higher of fair value. Fair value, how do we get it? It is selling price minus selling costs. Selling costs. Next, value in use. Value in use is the discounted future values of cash inflows. You choose the higher of these. You choose the higher of those 2. You choose the higher of A and what? B. You choose the higher of that. That is step 2. Step 3. Step 3. Compare compare carrying amount, that is your answer in step 1, to recoverable amount. That is your answer in step 2. Now, if carrying amount is greater than recoverable amount, there is impairment loss. Impairment loss, or revaluation downwards. Revaluation downwards. If recoverable amount is greater than carrying amount, in that case, we have revaluation upwards. Now, that leads you to the last step, step 4. Step 4 is accounting treatment. Accounting treatment. If recoverable amount is greater than carrying amount, we have said it's equals to revaluation upwards. The accounting treatment is you debit asset. In other words, you increase the value of the asset, and you credit revaluation surplus. You credit revaluation surplus. You debit asset and you credit revaluation surplus by the amount of the difference, by the amount of step 3. Now, that is if it is a revaluation upwards. For the case, if carrying amount is greater than recoverable amount, it is what? Impairment loss, or revaluation downwards, okay? So in that case, you debit income statement, that is expense. You expense. When you debit income statement, it means you are expensing. You debit income statement and you credit asset. You reduce the amount of the asset. When you credit asset, it means you are reducing the asset. You credit asset. NB. So here, please understand, this is part A. This is part B. NB. Note NB. If revaluation downwards is for an asset that had previously been revalued upwards. If revaluation downwards is for an asset that had previously been revalued upwards, what do you mean by that? In the first year, hey, Austin, you are interfering, yeah? So if revaluation downwards was for an asset that had previously been revalued upwards, what do you mean by that? Maybe in the first year, you revalued an asset upwards. So when you revalued upwards, what did you do? When you revalued upwards, you debited asset and you credited revaluation surplus. I hope we are together. And then in the second year, the same asset is now being revalued downwards. What you do, first of all, you first clear revaluation surplus in the first in the first year. In the first year. So what you will have two debit entries. I will explain this through an example, and then you'll have one credit entry. The credit entry is you credit the asset because it's a revaluation downwards. Now, you first of all remove this revaluation surplus in the first year. When there was revaluation surplus, you credited. So you first of all debit that surplus. You debit revaluation surplus in the first year. You remove it. You remove it by debiting it because it was credited. And then the balance is taken to the income statement. The balance, not their balance. If you can remember these points I've listed, there is no question. There is no question on IS 16, which will be a problem. There is no question on IS 16, which will be a problem if you can remember those points. So that is our summary. Why don't we look at a question? Can we look at a question?
Let's finish writing down the.
Oh, you are still writing? Sorry.
Yes.
This lecture still wait minutes. We are still taking notes.
You know, when the president says, when the class president says, "Who am I?" A normal citizen cannot go against what the president has said. I'm waiting, eh? Are you done? Have you finished?
Not yet.
Yes. But they can revisit the record as well.
Yes. I'll share with you this. I'll share with you the link. The problem
Which is okay.
My IT person is really taking time to, because I need the IT person to edit the video to reduce the size, etc. Otherwise, the alternative is to share it through the Google Drive. And then I give you the link. Maybe I'll go through that route. Or I can upload them in YouTube, but I make it private. I share with you the link in the YouTube. Is that okay?
Very perfect. Instead of wasting time like this.
Okay.
Yeah.
Waste his time on this.
Okay. So let's continue, please.
Wasting the time. You Denise wa Musa.
Now, okay, somebody's in a hospital.
Hello.
Let us move on. How can I remove that writing in the screen? Let me see. No, it cannot delete it.
Unmute.
Hey,
Unmute.
hey. And
Okay, so let's move on, please. There is a question in your notes. This question, I'm trying to look for it. Yes, it's a very important question. This question in your notes, there is a question like that. Kindly take a minute to read it. Take a minute to read that question. It is in your notes. If you have your notes, you can just go and see it there. It is a very important question. It summarizes everything. Please don't write the question. It is in your notes. Just read. Now, whenever you receive a question, we can now read it together. Whenever you receive a question, mostly this is always question 4 in your exams. Question 4. Most question 4s, just check the past paper questions. Most question 4s are on standards. So whenever you receive the question 4, read the required first so that you know which standard is being tested. So you are being asked, prepare extract of financial statements. So you'll have to prepare extract. Extract is a part of financial statement. It's not a whole financial statement. Prepare extract of financial statement of Smart Limited, including movement in reserves for the year ended 30th September 2001 and 2002. Part B of the question, look at part B. Explain how initial PPE should be measured. 2 marks. Number 2, the circumstances in which subsequent expenditure on assets should be capitalized. Number 3, explain IAS 16 requirement regarding revaluation of non-current assets and the accounting treatment of surpluses. Please, please, please. Class rep, you are making noise. Please, when you are talking to somebody, be outside class. So, what am I trying to say? This part did not need this information in the question. This part, it's either you know or you don't know. So explain number 1, how initial PPE should be measured. So I've just put this to save your time. Number 1, how should initial PPE should be measured? Initial PPE should be measured at cost. And then you'll come and say cost include. Do you remember the points you have said? Costs include point number 1. What have we said? Purchase. You remember that? Purchase, price, and then you put all those points you have. I'm just moving on. Those costs attributable, you write it in full. We don't have time to write everything. You write it in full. Number 3, dismantling. You'll write it in full. I don't have time to write in full. Number 4, borrowing costs. Borrowing what? Costs. So that is, look at this. What does it ask? Explain how initial PPE should be measured. So what have we said? Initial PPE should be measured at cost. Cost includes, I hope you understand me. You write it in full. I've just written summary because of time. Number 2. So that one, again, it is there in your notes. Do you agree we move on? Number 2, circumstances, this point, circumstances in which subsequent expenditure on those assets should be capitalized. Circumstances on which subsequent should be capitalized. So number one, the first circumstance is modification. Go and find out what did we say about modification. Modification, you complete the statement. Next, number two, we said number two, upgrading. Upgrading, you also write it in full. We have just written. I don't need to repeat. Number three, what was number three? Adoption of a new production process. You go and write it. Remember, questions on standards, they pick directly from the standard. Number four was, I remember it was extension to a building. You have earned that. So these are circumstances in which in circumstances of capitalization of subsequent what? Expenditure. You remember those 4 points. The last question is, explain IS 16 requirements regarding revaluation of non-current assets and the accounting treatment. So there are 2 parts in this question, and it is a lot of marks, 6 marks. So the question has got 2 parts. Explain IS 16 requirements regarding revaluation. IS 16 requirements regarding revaluation, that is the first point, and the accounting treatment of surplus and deficits. So I'll start with requirements regarding what? Revaluation. Requirement number 1, when an asset is revalued from a particular class, comma, then all assets in that class should be revalued. We learned about that. Number 2, you should be consistent. Revaluation should be consistent. You should be consistent in your revaluation. We said, for example, e.g., every what? Every 3 to 5 years. Do you remember that? Number 3. What was number 3? If you can remember, you should, when there is revaluation upwards, when there is revaluation upwards, debit, sorry, let me not go that way. When there is a revaluation upwards, take the revaluation surplus to what? Equity in the statement of financial position. Number 4, revaluation surplus should be amortized with the remaining lifespan. What we are doing is very important. Lifespan of the asset and the amount of depreciation taken to retained earnings. So this is the first part of the question. The second part of the question was accounting treatment of surplus and deficits on revaluation. So accounting treatment of surplus. So accounting treatment of surplus, we debit asset. Did you remember that? we debit asset and we credit revaluation surplus or reserve. Reserve is also called a surplus. Okay, that is in case of a accounting treatment of a surplus. Next, accounting treatment of what? Deficit. You debit
Income statement.
That is you expense. You expense. Okay, and do what? And you credit asset. But in case it is an asset that was previously revalued, you know what to do. Do you agree? In case of an asset that was previously revalued upwards, what do? If it was previously revalued upwards, there will be two debits. There will be two debits and there will be one credit. Asset, and you debit revaluation
surplus and income statement.
Revaluation surplus and income statement. Income statement with the balance. So that
can we call upward like bargain power?
Pardon?
Is upward surplus can be called bargain power?
No. Revaluation surplus. No. According to IS 16, no.
Okay.
Yes. I'm just quoting the standard directly. You know, I'm always an expert in standards. Okay, so that is what we needed. Now, there is a part of the question that is now calculation, and it takes a lot of time. So let's read the question carefully. Pardon? These ones are directly from your notes. If you don't remember, you just go back to the notes we have covered. Is it true? Are these points from your notes?
Yes, it is there.
It is there. So allow me just to move on because, you know, financial reporting is very wide. So let's read this together and then we solve it. So we are being told, Smart acquired a 12-year lease on property on 1st October. So date of acquisition, I've written for you here, date of acquisition is 1st October. You can see that. On 1st October, and they paid how much to acquire the asset? They paid 240,000. Okay. There is something I think missing. Somebody to go to the Word document. I'm seeing amount there. Is there something I left out? Somebody to go to, if you have your Word document, just confirm if there is something I left there. I'm just seeing some amount there, which means there is something hanging. Somebody to go for me in the Word document. I don't have it. Is there something we have left out there? I'm asking a question. Okay, I have the notes, but I don't.
It is okay.
The question is okay.
Yeah.
Okay. So if you tell me that, then we can continue. New share. What are you seeing in the screen? Okay, so I hope. Why am I feeling the question is not complete? Okay, let's just read. So Smart acquired a 12-year lease on property on 1st October 2000 at a cost of 240,000. Okay, now annual amortization is calculated on the carrying values at the beginning of the year. The company's policy is to revalue its property to their, so let me maybe remove this so that I don't get confused. This word amount, let me just remove it. So the company's policy, okay. Who is this? Imagine that is a class rep who is disturbing us. What should we do to him? So the company's policy is to revalue its property to their market value at the year end. Accumulated depreciation, because it is a leased property, that is why they are using the word amortization. But if it was a freehold property, a property you buy permanently, we will talk of depreciation. Accumulated depreciation is eliminated and the property is restated to the revalued amount. To the revalued, actually that word amount was supposed to be here. To the revalued amount. Okay, to the revalued amount. I was wondering where it was coming from. Now, the market value of the property on 30th September 2001 and 2002 were 231 and 175,000 respectively. The existing balance on the revaluation on 1st October 2000 was 50,000, and this related to some non-depreciable land whose value had changed significantly. Now required, prepare. Now what I said was this: if the question has not asked you to calculate the cost, you remember this question, what you are seeing here, this one had asked you to calculate the cost. This one had also asked you to calculate the cost. You know the way the questions on costs look like. Now, if the question has not asked you to calculate the cost, now this one is just an advice to pass exams. Whether you understand this or you don't understand, follow the 4 steps. Do you remember the 4 steps? I'm asking a question.
Excuse me, sir.
Yes?
Excuse me, sir.
Yes?
That second, the second sentence, annual amortization is calculated on carrying amount. It is not in any our note.
It is not in the notes.
Yeah. The second sentence in our note is the company policy is to evaluate the property in the market value at the year end.
Okay, what you do, read for me the whole question. Read for me, start from the beginning.
Smart acquired 12 years lease on property on 1st October at a cost of 240. The company policy is to evaluate its property on the market value at the year end. Accumulated depreciation amortization is eliminated and the property is restarted to the revalued amount. Annual amortization is calculated on the carrying value at the beginning of the year.
Read again what you have said.
That is the second sentence in
it is the
question.
second sentence. It is just that I misplaced it.
Yes, I think. Yeah.
Can we continue?
The annual amortization is calculated at the carrying value at the beginning of the year.
Okay.
The market value of property on 30th September 2001 and 2002 were 231 and 175 respectively. The existing balance on revaluation at 1st October 2000 was 15, and this related to some non-depreciable land whose value had not changed significantly since 1st October 2000.
Thank you for reading. I just misplaced the words because of just transferring it from Word to Excel. But everything is there. Do we agree?
Okay. Yeah.
Okay. Now, what I was saying, in such a question, do we all agree before we start that this is a very difficult question? You even don't know what is to be done. Are we together? Now, in a question on PPE, which does not ask for the cost, follow the 4 steps. Are we together? Follow the 4 steps. If you follow the 4 steps, whether you understand the question or you don't understand, you will at least get 90% of the marks. I hope we are together. So we did not understand this question. Let's assume we did not understand. Prepare extracts of statement of financial position of S, including movement in revaluation reserve for the year ended 30th September 2001 and 2002. Let's assume we do not understand. And now let's come and start working. Please, you are the ones to guide me. What is step 1? So there are 2 years. There is the first year. We acquired the property on 1st October. What is end of the first year? First year ends on 30th September 2001. Second year ends on 30th September 2002. I hope we are in agreement. So for the first year, let's do step 1. What is step 1? Somebody to help me? Step 1 is? I'm waiting for an answer.
Calculate the cost.
Calculate what?
The cost.
No. Look at the second point that we said. After calculating the cost, what else did we say? Steps. Step. I'm asking, is there somewhere we wrote step 1? I think we wrote step 1 somewhere. What is step 1? Calculate the carrying amount. Did I talk of that? Did I talk of something like that? Check your notes.
Yes, we said.
Yes. I said that. I remember very well.
Step 1 is
yes,
it's current amount.
Which is the cost of the asset minus what?
Minus accumulated
Depreciation.
Minus
Depreciation.
any impairment
loss.
loss. If there is no, you don't calculate. So what is the cost of the asset? Cost of the asset, you go to the leases. Let's read here. Smart acquired a 12-year lease on property on 1st October 2000 at a cost of what? 2,000. Do you see that cost? At a cost of how much? 240,000. I hope we are all together. At a cost of that. You less what? We have said you less accumulated depreciation. Accumulated depreciation. Remember, we are in the first year. Let me remove that from there and maybe post it there so that I have space for working. What is accumulated depreciation? It is the cost of the asset is 240,000. Please understand me. Divided by 12 years. Do you agree with me? Do you agree with me?
Yes.
So somebody to help me with that answer. How much is that?
Yes, we do.
How much is that?
It is 20.
Divide
It's
by
20.
so 20,000. We didn't have any impairment in the first year. So let's
12 years or 12 months.
impairment. Pardon, where did we get? I'm not understanding the question.
12 years.
The lease is for a period of 12 years. So we depreciate it over 12 years. Have you seen that?
Yeah.
Okay. So what is the carrying amount?
It
Somebody
is
to help me?
220. 220.
So 220. You can all see that it is 220. Remember, where there is 0, I also put it. So the carrying amount is 220. And I can also bring it here so that you can clearly see. Yes? Step 2. What is step 2? Somebody to help me, step 2. What is step 2? Calculate what?
The recoverable amount.
The recoverable amount, which is what? Higher of what?
Fair value.
Fair what?
Fair value.
Value. And fair value, we said, is the selling price. Do you remember that?
Amount.
So let's talk here. The market value of property on 30th September 2001, we are at the end of 2001, was 231,000. So it is 231,000, 230, so is equals to, maybe let's talk of sales value or the market value minus selling costs. Minus selling costs. So that gives you, do we agree? That gives you 231. There are no selling costs in this question. Now B
is value in use.
In
use.
What is value in use? We said value in use is what? Discounted.
It's discounted.
Future values of cash flow. Of cash flow. Now we didn't have any, so it is 0. We do not have any. Do you agree we do not have any value in use? So what is recoverable? Therefore, the highest is what? 231. Financial reporting is very interesting if you understand the concept. Is 231. Step what? Step 3. What is step 3? Compare what? Carrying amount and what? Recoverable amount. So in this case, the recoverable amount is more than the carrying amount. Do you agree? Recoverable amount is greater than what? Carrying amount. Therefore,
it is
there is revaluation what? Revaluation upwards. Upwards. By how much? Recoverable amount, remember, is 31. Do you agree with that? Is greater than the carrying amount. Carrying amount is 220. Okay. Somebody to help me. So we are done with that. What is the next step? Step 4. What is step 4? Accounting. Accounting treatment. Accounting treatment. What you do there, you debit, what did we say? Assets by the difference. What is the difference? 231,000 minus 220. What does it give you? Do we get 11,000? I'm asking a question. Do we get 11,000? Credit, revaluation, reserve. Also, how much? 11,000. And that was the first year. Now, in the second year, again, I repeat exactly the same steps. So I'll just copy so that I save time. I'll copy so that I save time, not any other reason. So that I save my... Now, I'll just copy and make corrections. So step 2, year, the second year, that was the first year. So let's go to the second year. The second year, now the rules that you are reading for me. Annual amortization is calculated on the carrying values at the beginning of the year. The next statement is important. The company's policy is to revalue its property to their market value at the end of what? Every year. Have you understood that statement? At the end of every year, the company is not using the cost. They are revaluing the property, and then the value at the end of the year is the beginning of the second year. So what I'm doing is this. Look at what I'm doing. So we are revaluing. So the new value is now 231. The new value is not 240. It is now 231 because we have been told the company revalues. So what is the new value? The new value, so I'll put there, new value according to the policy. According to policy. I'll put there a value. It is now 231. 231,000. Now, how many years are remaining? How many years are remaining? We started with 12 years. We started with 12 years. 1 year is done. How many years are remaining? We started with 12 years. 1 done. Let me mute everyone. How many years are remaining? 11 years. So what you do, because we are revaluing every year, immediately you revalue, you start depreciation afresh. So 231 divided by 11 years are remaining. Somebody to give me the new amount. What is the new amount there? Somebody to give me the new amount. 231 divided by 11 years. Divide by 11 years. It gives you 21,000. Impairment is 0. So the carrying amount will be equals to the cost minus 21 minus 0. I hope we are together. The carrying amount is it 210 really?
It is true.
It is true. Oh, this was 220. Okay. I was wondering why we are getting. So that is 2. Okay. So let's go to recoverable amount. Recoverable amount in the second year. We were told in 2002, it was 175. So here it is now what? 175. I've gone to the wrong part. It was here. 270, 275. I hope you understand because I'm in year 2. Value in use is again not there. Therefore, the higher is what? 2 275 is the higher. So let me bring this 210 here. So we have 210 and we have 275. So somebody to help me here, compare carrying amount to the recoverable amount. Somebody to help me. Which one is more? Here, compare is recoverable amount, recoverable. Are we right? No, it was, why did I read? Was it 175? Sorry.
Yeah, 175.
I was wondering why it's coming to that. 175.
5.
Sorry for that. It was 175, not 275. 170. Please, if there is a figure, I'm also a human. We make mistakes, yeah? So if there is a mistake I've made, you just correct me. So, okay, so we are comparing. So in this case, we can say...
Excuse me, sir.
Yes.
Where can we use the 50,000?
Don't worry, I'm coming. I've not finished the question. Are we together?
Yeah.
I've not finished. Don't worry. Even if we don't finish today, we will finish. Okay, but I'll tell you where to use it, of course. So in this case, carrying amount is how much? 210. 210. Carrying amount is greater than recoverable amount. Recoverable amount is 175. Okay, so therefore, there is what? Impairment loss, or what is called revaluation downwards. There is revaluation downwards. So what will you do? Now, this is a very good example. We said, let's go to step 1. We said that this amount of 11,000, what you will always do, you will always take 11,000, you divide by 11 years, the years remaining. And this amount of 1,000, it gives you 1,000. 1,000 every year, you take it to retained earnings. So you always do this. It was the last step of revaluation. The last step, you always take this amount of revaluation, you divide by the number of years remaining, and then you depreciate by, you amortize by 1,000 every year. So that is what I want to do here. Look at what I'm doing. Debit, you debit. There are 2 debits. You understand why there are 2 debits. Why are there 2 debits? Because in the first year, there was revaluation upwards. In the second year, it is revaluation downwards. And then we will have what? A credit entry. Please, let's be together here. You credit asset by the amount of the difference. What is the revaluation downwards? Somebody to help me. 210 minus how much? Is it 35? Do you see 35? I'm asking a question. 210 minus 175 is equals to 35,000. I hope we all see that. So you credit asset with 35,000, and there will be 2 debits. The first debit, you clear the revaluation reserve. Revaluation reserve. And the second credit, you credit the debit income statement. Statement with the balance. How do you write statement? Statement with the balance. Okay. Now, what we are saying in this case, because it is a revaluation downwards and previously it had been revalued upwards by 11,000. By the end of the second year, if it had continued to be revaluation If we had continued to be revaluation, we could have depreciated it and we could have remained with 10,000 at the end of the second year. At the end of the third year, if we could have depreciated it, we could have remained with 9,000, like that until the 12th year. But now, because in the second year, things have changed, revaluation reserve, you credit the entire amount, 11,000, minus the depreciation. The depreciation is 1,000. So you debit 10,000. I know the question is, why have I removed this? You always depreciate the reserve. I've depreciated the reserve after 1 year and it was remaining 11 years. I've removed the 1,000. The balance to make it 35, this 35, let me post it here, 35. What is the balance to make it 35? Somebody to help me. What is the balance to make it 35? 25. So that when you add this and that, it gives you this 35. Now, if you do that, the question was very complicated and only few marks. But in your exams, it can be around 12 marks. This is complicated because I picked it from an advanced paper. I picked this question from AFR. That is why it is few marks. But in FR, if it is there, it's around 12 to 15 marks. Are we together? Now, in this case, what you need to do here in this case, you are prepare extracts of financial statements. We have finished with all that. If you don't understand, just stop there. You can get around 10 out of 12 marks. But if you are asked to prepare the extract, I just did this to save time. Income statement, you expense in the first year. This is the first year. What was depreciation in the first year? Was 20,000. So income statement, what goes to the income statement? Depreciation of 20,000. That is the only extract of income statement. We don't have sales, we don't have any other thing. So extract of income statement first year, depreciation was 20,000. Extract of statement of changes in equity. Statement of changes in equity looks like this. It looks like this. So you always have the first date. First, at the beginning of the period, when did we buy the asset? We bought the asset on 1st October 2000. Beginning of the period is 1st October 2000. We were not given any share capital. We were not given share capital. We were not given share premium. We were not given retained earnings. But somebody asked me, we were given at the beginning of the period, we were given the revaluation, 50,000. Do you remember somebody asking me the 50,000? The existing balance on revaluation at 1st October was 50,000. 1st October was 50,000. So I've posted that. So what is the total of the equity at the beginning? The total is 50,000. And then you make any adjustments during the year. Maybe if there is profit for the year, you add it. You add it there. But we were not given the profit. We were not given. If there is dividends, I'm just guessing. If there is dividends, if there is any dividends, you account for it. Dividends paid. In another question, you'll be given the dividends. We were not given. If there is dividends paid, you deduct it from the profits. And you also deduct it from there, if there is any dividends. This is a statement of changes in equity. Now, there was revaluation surplus. And our revaluation surplus, you put it in the column of revaluation. Revaluation was 11,000 in the first year. So this will give you 11,000 total. You know, I'm almost giving you a break. I'm seeing people are quiet. So in this case, you get at the end of the period. What is the end of the period? 31st Sept, is it? What is the end of the period? 30th September 2001. 31st September 2001. So the end of the period is 31st September. Here, we didn't have any figure. You add. There was no figure. Here, it is 61,000. And here, it is also 61,000. And that is what you do even for year 2. I will not do year 2 because of time. Now, here, extract of financial position. Everyone knows statement of financial position. We have non-current assets, and it is property. We acquired property. What was the cost of the property? I remember the cost of the property was 240,000. The cost of the property was accumulated depreciation was 20,000 at the end of the first year. The net book value is 220,000. Now this is what you'll be showing in your balance sheet. And then we were also told you'll also show your equity. Equity, you bring these figures here. And our only equity is revaluation reserve. Our revaluation reserve, you will show the amount of 61,000, the amount at the end of the year, 61,000. What have I done? Okay, you show 61,000, that figure there, you bring it there, 61. That is how to prepare extract. You repeat the same process for year 2, but time is not on our side. So these are what we call what? Extracts. Extracts are what goes to the balance sheet, what goes to statement of changes in equity, and what goes to the income statement. Any question? I will share with you these ones again. I will also share the video so that you go and sit down and just follow it slowly until you understand. Can we kindly do this?
Excel sheet.
Excel sheet I'll also share. Thank you. Now, let us have a 15 minutes break.
Question.
Yes, question?
Question about revaluation reserve depreciation. The
Uh-huh.
revaluation reserve is depreciated every year.
Yes.
Where that 100 be recognized?
1,000 or 100?
1,000.
You know, I have not done the second year. You see second year here. There is the second year here. Do you see second year? Do you see second year? I've not done it. Extract of income statement. So if I was to show you extract of income statement, you will show income statement. You will show first of all depreciation. Depreciation for the year. Remember again, it is an expense. Don't put it in income. It is an expense. So you will show, I just assumed you are in a position to do it, but let me not assume. I'll come here. What is the depreciation? 20. The second year is this. Depreciation is 21,000. I'll come there and write 21,000. Do you understand me? Yeah. Now, I'll come and also have another expense. I'll call the expense impairment loss. Impairment what? Loss. Impairment loss, you now go to this debit entry at the end. Do you see what goes to the income statement? What goes to the income statement? 25. Do you see 25? Yeah. So that is the income statement. What goes to the income statement is impairment loss is 25. The amount that goes to the income statement. Are we together? And then
Yes.
there is what goes as an income. So, sorry, what goes to, how do we call this? What goes to retained earnings? Retained earnings. It goes to retained earnings in the balance sheet. So this is what goes to the income statement. So that is what goes. Now, extract of statement of changes in equity. You pick the figures from where you stopped here. From where you stopped in the first year. You pick the figures from where you stopped in the first year. So let me see if there is something I've left out. From where you stopped in the first year, I'll just post them. I think I've made a mistake somewhere. Which mistake have I made? Okay. Okay, I was to post from there. Paste. I'll post that. That is beginning of the second year. Beginning of the second
Yeah.
year. But now instead of writing 31st September, you write the start date of the year. It is 1st October. 1st October. And then everything that took place, you account for it. Was there any profit for the year? No. Was there any revaluation? Downwards. There was a revaluation what? Downwards. So here you will talk of what goes to the income statement. I'll talk of what goes to the income statement. Or I can just talk of revaluation. Revaluation downwards. Downwards. What was the revaluation downwards? Look at this. There is 25,000 we had taken. 25,000 we had taken to the income statement. The other one goes to revaluation reserve. Look at here. Second year, we debited revaluation reserve by how much? 10,000. Income statement was 25. So what you do is this. Revaluation downwards, you will come and remove it from here. You'll deduct 10,000. 10,000. Is that 10,000? Sure, it is 10,000. Again, you deduct it there. 10,000. You less it. You less. The key word there is to less, so that we don't forget. You less. And then there was also transfer. Transfer from what? Revaluation reserve to retained earnings. We are transferring from revaluation reserve 1,000, that depreciation you are talking about, and we are taking it to that.
Retain.
So here it is 0. 0. So transfer from, you remove it from here and you take it there. So it is 0. And then you get the totals at the end. What is the end date? 31st September 2002. You get these totals at the end of the year. The totals, here it is 1,000. Here it is this minus that. It gives you 50,000. And then this is this minus that. It gives you what? 51,000. Now, when you take this plus that, it is still the same as this minus that. I hope I've done the extract. I didn't want to do that, but because of your question, I've been forced to do that. Have I answered you? Can we have a break of 15 minutes? You can log out and then you log in at 3:15. Let us have Yes?
Excuse.
Yes?
Until now, I don't understand the origin of 12 years and 11 we use to calculate depreciation.
Thank you. Let us go back to the question. Smart acquired a 12-year lease on property. They leased the property for 12 years. So from the date of lease, the date of acquisition was 1st October. How many years will we be depreciating it? We'll be depreciating for 12 years. From which date? From which date? 1st October. So at the end of this year, the end of the first year is 30th September 2001. In the second year, we are now remaining with 11 years because the first year is done. Have you understood me?
Yes, yes, I understood.
Thank you.
Another question.
Yes.
What will be happen if we start by the first year with revaluation downwards, and then the second year upward? We
That is a good question. Can you ask me after the break?
Yes, no problem.
So let's have a 15 minutes. Remind me of that question after break. So let's come back at exactly 3:15. Let us be back to class. Just log out and then you will log in again, the same link. But me, I'm not logging out. But you log out so that you save your bundles. 15 minutes break.
Asangira ngenda. Kiri Somali hatari.
Irakomeye.
Ni hatari kabisa.
Yeah.
Sehemu cho.
Now, the people I sympathize with, are the people who got exemptions. Those are the people I sympathize with. But the others, when you revise, you will get it right.
But why they give them an exemption of accounting? They should give them economics or something like that. But
you know, that is ICPA now. That is not within our control. I think ICPA can answer that question very well.
they will suffer.
So they can come for extra classes, yeah?
Oh, sorry. It is better to give the Thorazi this summary of correction of questions.
I will email, I'll send you to the group. I'm sending it to the group. Dennis or the class president, remind me immediately after class, I send you.
Yeah, it will be better.
I will.
Because we see that the network is the problem. But after class, we can review.
Okay. Go for break, please. Go for break. Go and eat lunch, please. If you didn't take lunch, go and take lunch. Yeah?
Benjamin.
Yeah, colleagues. Go in the break to take a tea. And I will pay. As the Anjama.
Amasomo araha kabisa.
Brera, bitte. Hello? Brera.
Yes, I'm ready. Who is calling me? What?
Austin.
Ah,
agasamarira akaza.
Jose.
Ese turataha ryari?
Oui. Makuru.
Uri kukubona?
Birakaze.
Don't worry, don't worry.
Akazi.
We understand during exam. Yata. Guys. Sanyange ndi Musanze akavuga kari kugwa se. Uko bagiyera.
Bose waciyeho. Bose bagiye kuruhuka.
Invoice uyu munsi bayizane.
Vai, primo e pose. Biragoye nyine. Pô, aya masomo ni danje. Epo biba byageze mu bindi bikomeye. Mapuro ndazujuje ahubwo reka ndume izindi nibagiwe ikayi.
Please. Mute.
Hello? Ni byiza. Ça va, ça va.
So welcome back. I hope you've taken lunch. If you've not taken lunch, it's really, we are going to cover a lot. Financial reporting needs when you are satisfied, when you are full. So let's come back to where we had stopped. There was a question I was asked. Can the person read the question again? Repeat the question. Sarah, can you kindly mute if you don't have a question? So I was asked a question. What about if the first year there was a revaluation downwards? What about if in the first year there was a revaluation downwards? What happens in that case? Remember, if it is a revaluation downwards, it even makes the work easy. Because when there is a revaluation downwards in the first year, it means in the first year, you debited income statement. You credited asset. I'm repeating, if there was a revaluation downwards in the first year, you debited income statement. You credited what? Asset. So debiting the income statement we account for it every year. Income statement, we don't accumulate. Emmanuel, keep the kid away, yeah? Okay. So let's continue. You know, when somebody is talking, you are seeing who is talking in the screen. It brings the... Okay, so let's continue. What I was saying that when there is a revaluation downwards in the first year, you normally debit. Let me write somewhere so that you see. Maybe I write here. Let me write here. So when there is a revaluation downwards, we said you debit what? Income statement. And you credit asset in the balance sheet. Now, if this was the first year, now when you come to the second year, and there is now second year, there is a revaluation upwards. There is no problem here. Revaluation upwards starts from where you had stopped in the first year. So in this case, you will not account for anything here, because every year we take the amount to the income statement and that is the end of the story. Income statement does not accumulate anything. It is the balance sheet that accumulates. It is the balance sheet that cumulates. Balance sheet normally cumulates. So this is an example of cumulation. Revaluation reserve is equity. Equity is also cumulated. But income statement, we don't cumulate. So if it is income statement, it is the end of the story. That year is done. When you are revaluating upwards, you revaluate upwards from where you had stopped in the first year. So if the value of the asset was brought down by 20,000, okay, let me give a good figure. If the value of the asset was brought down from 1 million to 800,000, when you are revaluing upwards, you revalue from 800,000 going upwards now. You revalue from 800. So you have already accounted for this. So in the second year, if it is still that, what you do, you just debit asset and you credit revaluation reserve. You credit revaluation reserve with the amount of the increment. Along the way, we'll be covering many standards and we will get a standard like that. That brings us to the end of PPE, IS 16. Any question on PPE before I wind up? I want to go to a new standard. Now, my humble request is this. Read on IAS 40. Read on IAS 40. What is IAS 40? IAS 40 is?
Investment property.
Investment property is accounted for in the same way as PPE. Are we together? Accounting treatment is the same. Accounting treatment is the same. It is just that we are always using the revalue. We are always using fair value. Accounting treatment is the same. So you can read on that. If you get a question, you can ask me. Now, let us go to a standard called IAS 36.
Sorry, sir.
Yes?
There is sometimes when the AIS 16 is when you want investment property to PPE.
I'm not understanding you.
Sometimes you want to hand off a question by transferring the property and plant equipment to investment. And you transfer that investment to the property and the plant and equipment, and you can be asked how you can record that transaction.
Now, can I answer that question in our next class? Go and read I've tried to summarize investment property. It will not even take you 10 minutes to read. Go and read that, and then I can answer you after you have read. Are we together?
Yes, sir.
The answer is in the notes. So go and read, and then I can answer you after you have read. So that is a very complicated question to answer now, because it will need again some 20 minutes also to explain doing example. So go and read that, and then you can ask me in our next class. Not on Wednesday. Wednesday we have another class of another standard. Wednesday we are going to cover IFRS 16, because it's a combined class. There are Kigali students who are around, Kigali students are around 110. You people, you should be around 48. So it will be a very big class. So I'll only cover one standard IFRS 16, which is leases. Leases is very important. So let me answer you that question after you have read. Can we continue, please? Okay.
Yes.
I'm seeing people are really looking for network, until somebody is outside completely.
Yes, I'm outside completely. Maybe you will be back on what you have told.
Okay, so let's go to a new standard called. Now, do you understand?
No problem. But
do you
kindly
understand why I'm covering this standard after IS 16? I hope you understand why I'm covering. Have we covered impairment laws in IS 16?
No.
We have covered
No,
impairment
not yet.
laws under IS 16. Remember the steps. What are the 4 steps? The 4 steps, step 1, carrying amount. Step 2, recoverable amount. Step 3, compare.
Recoverable amount.
Step 3, compare. We said if carrying amount is more than recoverable amount, there is impairment what? Loss.
Yes.
There is impairment loss. So we'll start by looking at what is the objective. Any objective is always to prescribe the accounting treatment of that particular standard. So the objective of IS 36 is to prescribe the accounting treatment of impairment loss. And then you add by saying the objective is to ensure you don't state an asset at a value more than their recoverable amount. To ensure you don't state an asset at a value higher than their disposal value or value in use. That is the objective. Some definitions. Now let me mute people. When you have a question is when you will ask. Because now they are messing me and okay. Okay, so definition of terms. We had already defined impairment loss. The amount by which the carrying amount of an asset exceeds its recoverable amount. So the amount by which the carrying amount is more than the recoverable amount. That is what is called impairment. Carrying amount, what did we say carrying amount is? Cost of the asset minus accumulated depreciation minus any impairment loss if it is there. Carrying amount, we have already looked at it. I'm just defining terms so that we move on. Recoverable amount, what did we say in IS 16? It is the higher of what? Fair value and value in use. What was fair value? The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between two market participants. It's generally the selling price of an asset, you minus the selling cost. What is value in use? It is the present value of future cash flows expected to be derived. We had already looked at all those. And now, this is the first point we are learning under IAS 36. If you understand IAS 16, we will take like 30 minutes in it, and then we introduce a new standard. We introduce and then we will continue tomorrow. By 5, we can introduce another standard. So it's a requirement of IAS 36 that when getting projected cash flows, it's a requirement of IAS 36 that when you are calculating the value in use, don't use more than 5 years. Don't use cash flows of a period more than 5 years. What is the reason why we are not allowed? Unless you can justify. This is because accuracy of more than 5 years would not be certain. So when you are calculating value in use, don't use figures for a period more than what? 5 years. Unless you can say that I'm very sure, even in the 6th year, I will earn 1 million. I'm very sure, even in the 7th year, I'll earn 1 million. Unless you are very sure. But don't calculate value of use for a period more than 5 years. Because 5 years from now, you cannot predict it easily. Now, remember we said, when calculating value in use, you discount the cash flows. How do we discount? Most of you, I taught you business mathematics. If I didn't teach you, Mokoro taught you. Now, how do we discount? When discounting, you use this formula. You can see the first formula. You use the first formula. Present value is equals to 1 divided by 1 plus r raised to power n. Now, there is an annuity, what we call an annuity. Annuity is when we have the same amount of cash flow every year. The same amount of cash flow every year. Present value of annuity is equal to, okay, this is wrong. This is wrong. It is 1 minus. It is not 1 plus. It is 1 minus. So, you know, there are some people, maybe somebody's even in a motorbike and is attending class. So, okay, so present value of annuity. So I'm saying this is not right, but it is a picture I posted here, so I cannot correct it. It is supposed to be 1 minus 1 divided by 1 plus r raised to power n, everything divided by r. Note that this is less, it is minus, it is not plus. That was a mistake. Now, the question is, what is impairment? Impairment arises when the carrying amount of an asset is more than recoverable amount. What are some of the causes of impairment? They are what we call indicators of impairment. I remember the last time we were in class, we said that, for example, if your motor vehicle is involved in an accident, that is an indicator that the value will be less. That is an indicator that your vehicle is impaired. Now, indicators of impairment, at the end of every year, we should always review for the impairment status. At the end of every year, we should review whether the assets are impaired or not. Now, when you are checking for impairment, we have what is called external indicators of impairment, external indicators of impairment, and we have what is called internal indicators. What are external? These are factors that affect everyone in the industry. For example, inflation. Inflation affects everyone. So inflation may be an external indicator. Internal indicators, these are factors that only affect your business. They do not affect other businesses. For example, accident. Accident does not affect other people. It only affects what? You. Okay. So external indicators, maybe the market value of the product you are selling has gone down. The value of your property will also go down. Negative changes in technology. When technology changes, maybe you are using an old technology. That is an external indicator of what? Impairment. Increase in market interest rates. When market interest rates increase, inflation rate goes up. That will be an indicator of impairment. Now, maybe let's go to the next. Internal indicators. Maybe your product, only your product is obsolete or it is damaged. Your asset is idle, you are not productive. Worse economic performance than expected. Only your performance is worse than what you expected. Subsidiaries, I will cover it under consolidation. Don't worry about that. Under consolidation. When there is an impairment, what did we say? You debit income statement and you credit asset. Now, what is to debit income statement? In other words, you treat the amount of impairment as an expense. So recognition of impairment loss, what are you trying to say? An impairment loss is recognized whenever, okay, we've already explained that. I'm looking for, we've already explained whenever the carrying amount is more than recoverable amount. We've already explained that. And then I've said impairment loss should be expensed. I'm looking for that point. I don't know where I put it. Maybe I didn't put it in the notes. That is why I don't like using slides. I always like teaching when I'm writing. So sometimes when I want to go fast now, I must use slides. But I like teaching when I'm writing. I don't really believe in this. That is me. I don't believe in that much. Now, sometimes you have, like, for example, a factory. In the factory, it has got very many machines inside. The factory has got many machines. Now these machines have got different assets with different lifespans. But all these machines, their work is one, to produce the output. Maybe we are to produce a vehicle, maybe Volkswagen assembling plant. They are to produce a vehicle. So in this Volkswagen assembling plant, they have different machines. And these machines have got different lifespan. Maybe another machine, its lifespan is 5 years. It does activity XYZ. Another one, its lifespan is 2 years. It does activity XYZ. They perform different roles. But you cannot calculate the output of one machine. These machines must be combined together so that they produce one output. Such assets, a number of assets which are combined together to produce one output, we call them cash generating unit. Cash generating unit. Look at this definition I've put in bold. So what is a cash generating unit? It is the smallest identifiable group of assets that generate cash inflows that are largely independent of cash inflows from other assets. We are saying it is the smallest group of assets that can generate for you inflows, and these ones are largely independent from the cash inflows from other assets. They are called cash generating units. Now, steps in accounting for this one. Let me just teach it at this time. Steps in allocating impairment loss to cash generating unit. This one you may not understand without an example. So let me just highlight the important points and then I explain. I'm just highlighting for you important points. Okay, those are the 3 important points there. Now, when you have a cash generating unit, remember cash generating units, this is where we have a number of assets which generate one cash inflow. And you cannot separate them from others. Now, when you are accounting for impairment loss of a cash generating unit, the first step is to charge impairment loss to the specific asset that is impaired. You will understand it through an example. You charge impairment loss to the specific asset that is impaired. The second step, if the impairment is not over, you next charge it to what we call goodwill. I will give an example. And then you charge to the remaining assets on what we call pro rata basis, depending on the value of the asset. So when you are charging impairment to cash generating units, just master this. Number 1, charge impairment to the specific asset impaired. Number 2, charge impairment to goodwill. And number 3, charge to the remaining assets in a pro rata basis. Reversal of impairment. Please, what is to reverse? To go backwards. Now, when we talk of reversal of impairment, we have covered this in IAS 16. Do you remember period 2? Period 2, where period 1, there was a revaluation upwards. And then in year 2, there is a revaluation what? Downwards. So you will start by reversing the revaluation upwards in the first year. You reverse the revaluation upwards in the first year. So if you are charging impairment on an asset that had previously been revalued upwards, you first of all clear the amount in the revaluation reserve. That is what is called reversal of impairment. So look at the words I've used. If impairment had occurred to an asset which had been revalued upwards before. We should offset the amount of revaluation reserve, revaluation surplus account before we charge the remaining amount to the income statement. What we had just done before. Debit revaluation reserve, debit income statement with the remaining amount with the balance, and you credit asset. NB. As we finish and then we go to examples, IAS 36 prohibits reversal of impairment on goodwill. You cannot reverse impairment of goodwill. We will cover these in a standard called IAS 38. IAS 38 is intangible assets. Now, before I move on to calculation, let me summarize. You remember summarize? What you should try to remember. I always like summarizing a standard so that summary, what you should try to remember. Number one, you should steps in, so number one, accounting treatment. Accounting treatment of impairment. Impairment loss. So that is summary. The first item you should remember is accounting treatment of impairment loss. How should we treat impairment loss? Accounting treatment of impairment loss. Now, under accounting treatment of impairment loss, you already know the steps. I will be repeating the steps until you get used to them. What is step one? Calculate the carrying amount.
Carrying amount.
What is step two?
Recoverable amount.
Recoverable amount. Amount. What is step three? Step three, compare. Compare what? Compare carrying amount to what? Recoverable amount. So if carrying amount is greater than what? Recoverable amount, there is what? There is impairment loss. Okay. Step four. What is step four? Accounting what?
Treatment.
Accounting. Remember, we are only covering questions with impairment loss. Accounting treatment. So what do? You debit what? Income statement. Income statement. And you credit asset account. However, if it is reversal of what? Impairment. If it is reversal of impairment, you will have two debits. You debit revaluation reserve, and then you debit again income statement, and you credit what?
You credit asset.
You credit asset. That's it. Now, if it is cash generating unit in step 4, now summary number 2. Number 2. Oh, sorry, I've made a big blunder there. I should have copied, I should have duplicated instead of deleting. So number 2, for cash generating units under step 4. What is step 4? Under step 4, you know step 4, accounting treatment, yeah?
Yeah.
Accounting treatment, follow the following. Follow the following procedure. Follow the following procedure. Procedure 1, charge impairment What have we said? Impairment to specific asset. Number 2, charge impairment to goodwill. And number 3, charge impairment to, so it's called impairment to remaining assets on pro rata basis. I will explain what pro rata basis is. Please, in impairment, remember those summary. The summary is very small. The first summary is the steps. Carrying amount, recoverable amount, compare, accounting treatment. And then the second summary is for step 4, when we have cash generating units. For step 4, when we have cash generating units. When we have cash generating units. Under step 4. So that is summary as we continue with it. Continuation of the summary. Okay. You know, it's good to relax for 30 seconds so that we digest, we get what we are covering. Now, that is the end of IAS 36. What is remaining is examples that will take us some time. So let me move to example 1. You can read it from there, and then I go to Excel and do it. This is also in your notes. Now, in IAS 36, we will also cover June 2019. Just write it somewhere, I may forget. Just write somewhere so that I don't forget. June 2019, question 4B. It was 9 marks. June 2019, question 4B, 9 marks. Write for me somewhere so that I remember. It will be our third example. June 2019, question 4B. It is on IAS 36. It will be our example number 3. Take 30 seconds to read that question. And then we go to Excel. I hope you have read. Let me. So it reads, XYZ company has a single manufacturing plant which has a carrying value of 749. A new government elected in the country passes a legislation significantly restricting export of the product produced by the plant, and as a result of the foreseeable future, the production would be cut by 40. That is an indicator of impairment. A new government elected, it passes a law that restricts exportation of the product. Okay, next. The following are the cash flows forecast projected for the next 5 years. That information is helping you to calculate value in use. Year 5 cash flow includes disposal proceeds. There is no problem with that. If the plant was sold now, it would realize 650,000 and the cost of sales would be 69. That is the fair value. Okay, let's continue. The entity estimates that the pre-tax discount rate specific to the plant to be 15% after taking into account, so 15% is the interest rate. So calculate the recoverable amount and the impairment loss, if any, and show the accounting treatment. Remember the 4 steps. Remember the 4 steps. So let me go and share the workings. it is always important to be in class. Because we don't know where Emmanuel is. And Sarah. So, okay. Now, let's read through the same question that you have had there. The same question. I've just put it here. So, now what is step one? Somebody to help me. Step one. Step one is to calculate what? Calculate carrying amount. Carrying amount. Carrying amount. Here you have been given, you don't need to calculate it. But if you are not given, it is cost minus accumulated depreciation in this question, minus any impairment loss, if any. Okay, carrying amount you have been given. So what is our carrying amount? So carrying amount is equals to, we were given
749.
749. I hope this one everyone will understand. Step two is to get what? Recoverable
amount.
Recoverable amount. It is a higher of what? Fair value. Do you agree? What is our fair value? Our fair value is equals to, somebody to help me, fair value. If the plant was sold now, it will realize 650 with a cost to sell of what? 69. So it is 650 minus 69. Somebody to give me that. What is 650? Somebody to give me?
Is 581,000.
5 minus
81,000.
So 581,000. So that is what? That is fair value. Let me call it A. A is fair value. What is B? B is value in use. In use. This time we have the cash flows. Do you see the cash flows?
Yeah.
Okay. So we have the cash flows. So what we'll look at here, we must discount the cash flows. So we will look at cash flow. Cash flow. We will have what is called discounting present value interest factor. It is what percent? 15%. And then I don't know how we'll write it here, so that let me write it there so that everyone sees this. 15 what? Percent. So next we have present what? Present value. Now understand me here. We will have year 1, year 2, year 3, year 4 until year 5. So somebody to help me, year 3, year 4, and year 5. I hope we all have calculators. We agreed. Year 1. Year 1 it's 230,000. Year 2 is 211,000. Year 3 is 157. Year 4 is 104. Year 5 is 233. That one. Now, I don't know why it is bold. Now, present value. Remember, what do you do? It is 1 divided by 1
plus other power n
plus 0.15 raised to power n.
Which is
Are we
the one?
together? So
Yeah.
N here, N is year 1. N is 1. So calculators, I don't have. Give me calculators to 3 decimal places. The first one is?
No calculator.
The person asking for calculator should also be having calculator.
Yeah.
Do you have that? I'm asking a question.
Yes, it is right.
Now, I just want to change the others. This one is power 2. Oh, sorry. I've changed the wrong one. I was to change year 2. Year 2. Year 2 is power 2. I'll just change power 2. The other one is power 3. The other one is power 4. And the last one is power 5. So those are the figures we have. So give me the present value. Present value is this times that. Do we agree?
Times.
Okay.
Yes, we are.
Now, up to year 5, that is what we have. Let me round off to the nearest whole number. So what is the total present value? Total present value of cash flow. So total present value is equals to 638. So that is the value in use. So in other words, value in use is therefore equal to what? Is equal to that 6. So it's equal to that. Let me put commas so that we understand very easily. Okay. And then there I put that so that you know it is a total. Okay. So that is value in use. What is fair value? Fair value is the what is recoverable amount? Recoverable amount is the higher of, I'm asking a question. The higher of fair value and value in use. So you can conclude therefore.
In use. So we're going to use in use is the highest one.
Yes. Therefore, recoverable, you are right. Recoverable amount is the higher. So what is the higher? The recoverable amount, which is the higher between 581 and 638. Which one is the higher? Value in use is 638. 638. Are we together? So that is step what? Step 2. Step 3.
Compare.
Thank you. Step 3. Step 3 is compare
Carrying amount and
recoverable amount. So you can see your carrying amount is 749. Recoverable amount is 630. So carrying amount is greater than what?
Yeah.
Therefore there is impairment.
No value in use. You want to present value.
Now, there is also somebody teaching somewhere. Can I now continue? there is impairment loss of how much? 749. It was 749 what? 1,000
Hello?
minus 638,081. So somebody to give me impairment loss is how much? Which is equals to? Somebody to give me? I've remained alone in the class. Hello, are you following?
Yes.
Okay, step 4.
Yes.
Step 4, what is step 4? Accounting what? Accounting treatment.
Accounting treatment.
Accounting treatment. What did we say is the accounting treatment? Debit, income statement, and you credit what? You credit, what do you credit? You credit
Asset.
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 Do you see IAS 36 is a very easy standard? Only if you understand IAS 16. Only if you understand IAS 16. Only if you understand IAS 16. It becomes a very easy standard. Any question on that? And we have answered all the 9 marks, 10 marks, averagely 10 marks in this question. It becomes very easy if you understand PPE, because PPE has got those 4 steps. Let us first of all look at a past paper. Okay, let's look at an example of a cash generating unit. How we look at past paper. Cash generating unit. Take,
Pardon, sir.
okay, what I'm saying this is how to account for impairment. So step one, you calculate what? The carrying amount. Step 2, you calculate the recoverable amount. Recoverable amount. Step 3 is to compare those. Compare. And step 4 is the accounting treatment. Are we together? Okay. Now, okay, I always just like making it a work. Okay, so let's move on. So in moving on, we are doing another example. That is what I'm saying. Before we look at that, June 2019 question 4B. So another example is there. You can look at it. Take 30 seconds to read it before we do it. 30 seconds to read that question. I hope you've read. Whenever I give you time to read, I mute as I do something else. Okay, a company runs a unit that suffers a massive drop in income due to failure of its technology. Due to failure of its technology. So which is the specific asset that was impaired? Specific asset impaired was what? Technology. The following carrying values were recorded in the books immediately prior to impairment, before impairment. Recoverable value of the unit is estimated as 85 million. The technology is worthless following, so technology is totally impaired, following its complete what? Failure. The other net assets include inventory, receivables, and payables. It is considered that the book value of other net assets is a reasonable representation. So this one, I wanted to also highlight it. Let me highlight that. Is a reasonable representation. I always highlight the keywords. Okay. Show the impact of impairment on 1st January. So step 1. What is step 1? You now, almost everyone now knows. Step 1 is to do what? Get the carrying amount. Always be singing these until you do exams. So until you do exams, you should always just remember the steps. So what is the carrying amount? The carrying amount, the following carrying values were recorded. So carrying amount will be equals to, let me just put it, will be equals to 20 plus 5 plus 10 plus 50 plus 30 plus 40. Okay, so somebody to give me, that will give us a value of, so that was just
155.
1, you know,
155.
There is a characteristic of financial statements we looked at under conceptual framework called verifiability. Denise, you remember that? Verifiability. So I'm just trying to verify what is not happening. 155. Thank you, Denise. We verified. So, okay. So you are reliable. In short, step 2. Step 2 is to get the recoverable amount. What was the recoverable amount? 85.
Yes.
So 85 million. So remember, all these are millions.
Compare.
Okay. Million. Let's step 3. What is step 3? Step 3. Compare carrying amount and recoverable what? Amount. Compare carrying amount and recoverable amount. So here we can say carrying amount is greater than recoverable amount, and therefore there is impairment what? Impairment loss of how much?
70.
How much? 155 minus 85. Somebody to help me? Hey, now 70 million. So let's go to step 4. Step. Accounting treatment. But this one, this is a cash generating unit. This is a cash generating generating unit. So you go to the notes that I said under cash generating unit. So how do you know that it's a cash generating unit? There are many assets. Do you see there are many assets? Some are tangible, some are intangible. Like
Yes.
goodwill is intangible, technology intangible, brand is intangible, this is tangible, tangible,
Yes.
intangible, and tangible combined. So
Yes.
now what were under these, what is the process that you follow? Number one, charge to number one, charge impairment to what? Specific asset impaired, which is in this case, it is what? Technology. Were we told technology? So technology is what failed. So that is the specific. So charge to the specific asset impaired. Number two, charge to goodwill. Number three, what did you say? Number three, to the remaining assets on what? Rata basis. Now, charge to the specific asset. Now look at this. To the specific asset, what was the value of the asset? 5 million. So what we will do, the total impairment is 70. So we will first of all take 70, we remove the 5 million. Okay? We are still remaining with an impairment of how much to account for? We are still remaining with an impairment of 65 to account for. We come here to goodwill. What is the amount of goodwill? 20 million. 20 million. Now look at what I'm doing. I'm taking is equals to the impairment we are remaining with is 65 million. You minus 20 million. So what we are remaining with is 45. Now 45 is charged to the remaining. 45 million charged to the remaining. On what? Rata. Now what we do there, so that we make our work organized, we look at carrying amount before impairment, and then we will have a column for impairment loss, and then lastly carrying amount after impairment. Hey. You want to teach the person talking? Let me maybe cut it and I post it from there. Okay, so that I have space to write this side. So look at this. The first one is to charge to specific asset. Specific asset was, so first was
technology.
First was technology. So first technology, what was the carrying amount before impairment? 5. So the carrying amount was 5 million. Now what you do here, you less the impairment of 5. The net amount is 0, carrying amount after impairment. You come to the second. Second is goodwill. Second is goodwill. What was the value of goodwill before impairment? 20.
20.
You charge impairment of 20. What do you remain with? 0 as the carrying amount after impairment. Next, third is what? Remaining assets. On what? Pro rata. Pro rata.
Pro rata basis.
So what are the remaining assets? Look at this. The remaining assets are brand, land, and building. Other net assets are not impaired because of this. It is considered that the book value of other net assets is a reasonable representation of the net. So that one does not change. So the other net assets, that is what we have. I'll copy that and I'll just come and paste it there. Okay. So other net assets have pasted their values there on a pro rata basis. Let me push them there. Pro rata basis. Now, what do we mean by pro rata? You take these plus that plus that. Somebody to help me? $90. So this will be, this impairment will be, look at what I'm doing. Impairment will be 10 over 90 times 45. That is to prorate. Do you see how much was remaining? 45. Do you see 45 was remaining here? 45 was remaining there. So it's what we are charging to the remaining assets on a pro rata depending on their value. So it is 10 over 90 times 45. The next one will be, somebody to help me, 50 over 90 times 45. The last one will be 30 over 90 times 45. So we have charged that. So here, the total impairment, so the total, okay. Next is the other assets, other net assets. Other net assets. So the other net assets is 40. So this will be 40. And these other net assets, we have been told they are not impaired. These ones are not impaired. So impairment is 0. The impairment of other net assets, they are not impaired. So the net book value will be 40 minus 0. So it is 40. This one is, how did we get that? It is 5 minus 5. It gives you 0 like that. So I can just scroll down there so that you see everything. So what is the total values? So total values, you just add the totals. Total is auto. I just get the total is 155. Before we started, the impairment was 70. You remember 70? Impairment was 70. The value after impairment is 85. And that is how to account for impairment. Is there a question? So, before we go to the last question, this is a past paper question. Take some 2 minutes to relax. 2 minutes. Don't switch off. Don't switch off so that we go to this last question, which is a past paper question. June 2019 question 4A. If you have the past paper, you can confirm that that is the question. Because I copied it, I must have left out some things. Just confirm if you have the past paper. 2 minutes to relax, don't switch off, and then you read that question.
Nasaba kujya gukora research yo kwirasa.
You can stretch from where you are, you relax, and then come back immediately. 2 minutes to just stand and stretch and then come back.
tree.
It is called FR. You people, let us pass FR together so that we move to AFR together. I also teach you AFR, but only if you pass FR. So let's all make sure we pass in this sitting, and then we move to AFR together. Do we agree on that? But you must start preparing now. Now, the question, people are still stretching. The question reads, QPIL. So can somebody, first of all, anybody with the past paper question, it is at the back of the notes, to confirm that that question is the same. I don't have it. Somebody to confirm the question. June 2019. Anybody with it to confirm so that we move on?
To confirm what?
That it is June 2019. If you have the past paper, June 2019 question 4B, that the question is exactly the same, so that we don't leave out anything. June 2019 question 4B. Okay, I can confirm if there is, I think I have past papers somewhere. Let me confirm. Yes. Have I emailed you these notes? Have I shared with you these notes?
No. Yes, we have
not shared these notes?
Yes.
Yes? I've shared.
Yes, yes. Yes.
Okay. So let's go to the end. The end, there are past papers. So I've said June 2019, question 4. So you remember this borrowing cost question, we had already done it. So question 4B. Yeah, so this is the question. We can read it from here, and then we just go and do it once we have read. So question 4B, it was 9 marks. QPIL owns metal fabrication equipment, which was acquired on 1st July 2016 for 2. Now, let me go slowly. QPIL owns metal fabrication equipment, which was acquired, not the date of acquisition, was acquired on 1st July 2016 for 200 million. So what is 200 million? That is cost. Do you agree?
Cost. Yes.
Okay. On 30th June 2017, that is after 1 year, on 30th June 2017, an impairment review conducted established that the equipment could no longer function as expected. The market condition revealed that the equipment could be sold for 180 million, having incurred cost to sell of 2 million. Could be sold for 180, having incurred cost of 2 million. What is that? Fair value. Do we agree?
Fair value.
So
Yes.
what is fair value? 180 minus 2 million. Do you agree? So
Yes.
fair value is 178. We continue. A further impairment review conducted on 30th June 2018, that is again now after 2 years, revealed that the same equipment could be sold for 190 million, having incurred cost to sale of. So this is fair value in the second year. Do we agree?
Yes.
QPL depreciates this equipment at a rate of 5% per annum on straight line basis. They depreciate on which basis? Straight line basis. In accordance with the requirement of International Accounting Standard 36, impairment of assets. Have we covered the standard? Yes. Explain how the above transaction should be recorded in the books of QPIL, giving financial statements extracts for the year ended 30th June 2017 and 30th June 2018. How many marks? 9 marks.
9.
So let us go to Excel. Please make sure you understand standards. When you understand standards, the questions are very easy. So always try as much as possible to understand. You get what each standard means. If you understand each standard, it becomes very easy. So what is date of acquisition? Date of acquisition
is the 1st July.
Is what? 1st
July 2016.
July 2016. Next, first year. End of first year. End of first year. End of first year is which date? 30th what?
31st.
June.
June
2017.
2017, sorry. End
Yes.
of second year. End of second.
Is 30 June 2018.
30th?
30 June 2018.
2000. What I'm trying to train you slowly so that you know any calculation you start with, it's important to note down the dates, especially in consolidation company accounts, etc. So let's start with first year. So let's start with first year accounting treatment. Accounting treatment. Hey, somebody's now this person, he wants us to end the class even if we have not planned to end. What is step 1? Step
Calculative carrying amount,
which is equal to cost minus accumulated depreciation. Do we agree? Minus any impairment loss. But here in first year, we can just leave out that. So what is the cost of the asset? Somebody to help me. What is the cost of the asset?
200 million.
200 million, that is good. What is the accumulated depreciation? Accumulated depreciation is? Read here. Read there. QPIL depreciates this at a rate of what?
5%.
5% per annum on what? Straight line. So it is what percent? 5%. Can I mute the person who is? Let me just mute this person. I've found out who was that. Emmanuel, what were you doing? Because I've muted you and everything has gone quiet. So 5% accumulated depreciation is 5% times 200 million. Okay, so this will give you 5% times 200. So it gives you 10 million. So depreciation every year is 10 million. So let us continue. So let's continue. On that date, it was conducted and established that the equipment, blah, blah, blah. The market value revealed that the equipment could be sold at 1. So what is the carrying amount? carrying amount will be equal to
200.
huh?
190.
190. Thank you. So is equals to 190. Next, step 2. Step 2. What is step 2? Recoverable what? Recoverable amount. So it is higher of fair value and value in use. So let's start with fair value. What is the fair value? The fair value we were given. What is the fair value? The first year.
Fair value is
180 minus 2 million. 180 minus 2. How much is that?
178.
178. That's good. What is value in use? We were not given. Value in use is what?
0.
0. So what is the recoverable amount? Therefore,
178.
Therefore, recoverable amount is equals to, maybe I put it there, 178. Here the carrying amount was 190. So step what? Step 3. What is step 3? Compare. Compare carrying amount and what? Recoverable amount. So you can see the carrying amount is given there. The carrying amount is given and the recoverable amount is also given. Recoverable amount is also given. Which one is higher?
Is carrying amount.
So carrying amount is greater than what?
Is the recoverable amount.
Recoverable amount. Therefore what? Therefore there is
impairment loss.
Impairment
loss.
Loss of how much? 190 minus 178.
12.
Of how much?
12.
12.
Yes.
So we can say of 12 what? Million.
Millions.
So we were working in millions. Don't forget that. We were working in millions. Always don't forget to write the value, millions. We were working in millions. So can we go to accounting treatment? Step 4, accounting treatment. Accounting treatment. Accounting treatment is debit income statement, and credit what? Asset. And credit asset. So debit income statement with 12 and you credit asset with how much? 12. Do you see it's very easy? But that is first year. You are asked for the year ended this and the year ended 30th June. So we can copy the same and we repeat for the second year. Can I leave you to attempt the second year?
No.
Or we do it together? What do you want? You can attempt it at home.
We do it together.
Let us do it together.
Kindly, I'm in class. Okay, so let's do it together then. I'm just pasting with the formulas. Okay, so let's do it together. Second year.
Statement.
Yes, income statement. Asset.
Now, let us read the question carefully so that as I delete something, you tell me. QPL Metal owns metal fabrication equipment which was acquired on 1st July 2016 for 2 million. On that date, impairment review was conducted and established that the equipment could no longer function as expected. Market conditions revealed that the equipment could be sold at 180 million, having incurred costs to sell of 2 million. A further impairment review was conducted on 30th 2018 and revealed the same equipment could be sold at 190 million, having incurred cost to sell of 5 million. QPL depreciates this equipment at a rate of what? 5% per annum on straight line basis. So look at carefully what I'm changing. Now, I'll be forced to make a lot of adjustments. Accumulated depreciation, look at what I'm changing here, times 2. Here, times 2 years. Why 2 years? Somebody who can help me? Why have I put 2 years? Because we are in the second year.
Yeah.
So here will be, I'll just add times what? 2. So it will be 20.
Yes.
Are we together? Now,
Yes.
we find, was there impairment in the first year? You also less impairment. Remember carrying amount, impairment of what? First year. Did we have impairment of first year?
Yes.
Yes. What was impairment of first year? 12. You remember that? Remember carrying amount. This was a very good question. It explains everything in impairment, actually. This was a very good question. The person who said it knew really what impairment is. So that gives you, insert. I'm just trying to create more space. So that gives you carrying amount. So what is the carrying amount? Somebody to help me before you desert me. You know, it's very lonely to leave me alone. So 200 million minus that minus that. So it gives you 168. The new carrying amount is 168. Have you understood me?
Yes.
Okay. So remember, carrying amount, the definition is always carrying amount, let's write it in full, minus what? Any impairment. Don't forget that. So minus any impairment. So here we had first-hand experience on how to treat impairment. So minus any impairment. So don't always forget about impairment. If there was any impairment, you account for it. So we have next step 2, fair value. Let's go to year 2. A further impairment review was conducted, blah, 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 and we could sell it for 190 million with a cost to sell of 5. 190, step 2. Step 2 is fair value is now 190 with a cost to sell of how much? 5. So what is the net? 190 minus 5. How much do you get? 185. Value in use. So that is 185. Compare. So when we compare, what do you get? Can you compare for me, please? Here, do you see recoverable amount? Compare recoverable. Here it is recoverable amount is greater than carrying amount. Therefore what?
It is up.
There is revaluation upwards. Are we together?
Yes.
Of how much?
For
185 minus 168. 185 minus 168. How much?
17.
17.
Mm.
17 million of 17 million. Now, of 17 million. Now, in this case, accounting treatment is different. So what will be our accounting treatment? Somebody to help me?
Debit valuation.
Debit what?
Valuation reserve.
No. Debit
Asset
asset
and cash
and credit
flow.
what?
Income statement.
Revaluation reserve.
Upward.
Which is reserve or surplus. So by how much? 17.
17.
Ladies and gentlemen, that is the end of IAS 36. What am I trying to say? You people practice until you can be in a position to attempt any question in any standard. I'll be very happy if you read a question. First of all, you tell me which standard is that? So we are done with impairment. Tomorrow when we come, I will cover what? Tomorrow when we come, I will cover IAS 33. It is a very wide standard. IAS 33. Now, IAS 33. Hey. Dennis, we know what you are doing, huh? Okay, IAS. Okay, I'm just trying to continue. Now, what we say tomorrow when I come, I will cover IAS 33. It's a very long, it is actually the longest standard. So the whole of 4 hours tomorrow, let us keep time so that we cover IAS 33. I'm going to share with you this in the group, this working in the group. Are we together? Now, finally, let me take attendance. I've not been taking attendance and I was asked for attendance. So if you hear your name or if you hear somebody you know, you just tell me so that I record. So, Teles4, is he there?
I'm there.
Okay. Next, Alexis. Did anyone see Alexis?
No, he's not here.
Alphonse?
I am here. Alphonse, I am here, sir.
Oh, President, how are you doing?
Yeah, fine, thank you, sir.
Okay, let me continue with attendance. Ayubusa, Gilbert. Hey.
Yes.
French is difficult. Yes. Is this person there? Is that person there?
Who is it?
You can see the screen. Ayubusa, Jane, that one.
My eyes are.
Is there? He has mentioned. Well. Benjamin.
Those who have eyes.
Benjamin.
Look and read.
You don't have eyes.
Benjamin. Is it there?
Okay. Next we have Bonite. Bonite.
Jean-Pierre.
Next, Genzayo. Clesence.
I'm here.
Okay. Thank you. You are very clear. Consolatrice. Justin.
I'm here.
Okay. Next, we have Daniel. Denise. Next, Dioden. How do you pronounce that? Dioden. Diodin. Next we have Eliab. Okay, Diodin. Is Diodin there?
Yes, I am here. I am
Okay.
here.
Next, Eliab.
Yes, I am here.
Okay. Eliab is there. Next we have.
Yes, I am.
Emmanuel.
Yeah, I am.
Okay, thank you. Next we have Faustin. Faustin Amani.
I'm here.
Okay. There is another Faustin Muni Raguha.
Yes, Faustin Mani Raguha. Faustin Mani Raguha.
He's also there. Next, there is another
I'm
Faustin
here.
again.
Faustin Mani Raguha. Number 18. I'm here. I'm here.
Okay. Next.
Faustin Mani Raguha. I'm here.
Fidelin Abmatthew.
If it's raining, it's raining. 18.
18 have marked you. It is okay. 19, Fidelin.
I'm here.
Okay.
But it's raining very, very, very.
Okay. Charles. Okay. Abimana John. Hey, that name is difficult. John Nepe Mzim. Jean Baptiste. Okay. Next we have Idelphonse Makuja. Okay. Next, Dio Irambona. Okay. Next is John D. Okay, that one is he there? I saw him. Next is Nicholas. Jocelyn.
I'm here.
Okay. Next we have Mariam. Mariam. Please, let's not story. Please. Mariam. Morris.
I'm here.
Okay, Morris is there. Next we have Silas. Pauline. Hey, let us not make noise, please. Pauline.
We are unmuted.
Yes. Pauline. James. Theogene.
I'm here.
Okay. Next we have Venant. Venant Nishimana.
He's not here.
Next, Igide. Good luck.
Number 35. 35 is here.
Okay. Next, good luck. Good luck. Next, honest for.
I'm here.
Okay. Next we have Redemptor.
He's not here.
Okay. Sarah was there and was very noisy today. So Sarah tomorrow.
I'm here.
Okay. Next we have Antoine. Okay. Next we have Denise.
I'm here.
And Valence. Lastly, Valence.
I'm here. I'm here.
Who has not heard his name? Yes?
Present. Valence, present.
Number?
Emmanuel, I'm not.
Emmanuel. I saw Emmanuel somewhere.
I'm not on the list.
This one. Is it this one? Emmanuel, if you are not in the list, type your name, email address, and phone number in the chat, and then write "I'm not in the list," and then I'll take it up from there. Let us stop and meet tomorrow at exactly 8. Tomorrow at 8 in the morning. Let us.
Uyu mugore rero ahita agutanga kwa me